Stock buyback share repurchase occur when a company repurchases shares of its issued stock. Basically, a buyback takes place when the issuing company Macy's pays shareholders the current market value per share. Simply put, a company uses its cash to buy back its own shares. According to StreetInsider.com, since resuming its share repurchase program in August 2011, Macy's Incorporated has bought back approximately 152.2 million shares for approximately $7.3 billion through January 30th, 2016. So what is the issue here? The underlying issue with Macy's stock buybacks is its incentives to management to focus on short-term earnings per share, EPS, performance versus long-term growth. So rather than using cash flow for long-term research and development, many companies face pressure from shareholders to buy back shares. A buyback can boost earnings per share and total shareholder return. So number one is the board sets EPS and TSR as compensation metrics for the CEO. Number two is investors demand better returns. Number three, the CEO lobbies the board for a share repurchase program that buys back stock. Number four, share repurchases increase short-term share price and EPS. Five is the CEO pay increases while less money is available for R&D and capital expenditures. So why is it an issue? Stock buyback should not be used as a tool to increase earnings per share in order to open bonus/compensation metrics that otherwise would not be open. According to the article, The Real Effects of Share Repurchases, share repurchases occur more often in companies that are likely to miss earnings forecasts than those that don't. In basic accounting, the theory behind the buyback of shares is not to buy and hold the shares. Typically, a shareholder wants the share. We try to reduce the number of shares on the market and increase their percent of ownership. A company may choose to remove shares from the market for different reasons. For example, if the stock is undervalued, the company can repurchase the stock and resell it as the price of the share increases, to prevent a hostile takeover attempt and to meet targeted earnings per share goals. Subsequent to a stock buyback/repurchase, net income is divided by a smaller number of shares outstanding when considering per share profit. Hence, a stock buyback reduces the number of shares outstanding and does not change earnings. Typically, this can increase the price-earnings ratio and earnings per share. In many cases, a significant percent of executive compensation is tied to financial performance, including earnings per share. When this is the case, it creates a considerable amount of pressure on achieving short-term returns rather than long-term performance. According to John Kell of Fortune.com, 87% of Terry Ludgren's former Macy's CEO's total direct compensation is through incentives that are tied to changes in stock price and other predetermined performance objects. The table to the right shows the following: the amount of Macy's has spent each year of the last 5 years, the number of shares repurchased, and the average price per paid. According to Mark Fahey of CNBC, the four indexes on the following slide are weighted by market cap. On an unweighted basis, the 125 companies without buybacks have a median return of minus 5.1%, better than the median minus 6.4% return for companies that both reported buybacks and a reduction in shares outstanding. Additionally, the 100 companies with the highest buybacks as a percentage of market caps have a median return that is even worse at minus 9.5% in the last year. These companies include Big Lots, Hewlett-Packard, Macy's, Xerox, and Kohl's. Unfortunately, as buybacks continue to reach historic levels, many market watchers believe said companies are actually destabilizing their future growth and profitability. Buybacks don't buy much. Comparing the companies in the S&P 1500, those that have engaged in the largest buybacks relative to market cap since 2005 are underperforming the rest, while those that haven't had a single buyback are outperforming. So recommendations are, in our opinion, corporate top management has a fiduciary responsibility to the company's long-term growth and its owners, the shareholders. Based on this duty, the following are our recommendations. A significant percentage of top management compensation should be based on the actual performance and result of the business in terms of revenue and profit growth instead of stocks and options. This would minimize the potential misuse of stock repurchases to manipulate earnings per share, EPS. Per the compensation table below, equity is a non-cash pay that represents ownership in the company's stocks and options. And here's the table. So who gains from an open market repurchases? Their sole purpose is to give a company stock price and manipulate boost, and prime beneficiaries are the corporate executives who decide to do them. In 2012, 83% of $30.3 million in total compensation of the 500 highest paid executives from from realized gains from exercising stock options and vesting of stock awards. For corporate executives, stock-based pay is a ticket to membership in the 0.1% top income club. Recommendation number 2, implement a process that requires shareholder approval via proxy vote on all stock buybacks. The key concept is all assets, liabilities, and equity on the balance sheet belongs to the shareholders. Since the investment of the cash is considered contributed capital, the shareholders should approve significant transactions that involve said cash. Specifically, the shareholders should have the right to approve or disapprove the following: the use of cash for the stock buybacks, the use of cash for research and development, distribute to shareholders, and how much should top management receive. Recommendation number 3, the SEC should implement regulatory limits on stock buybacks. Before 1982, buybacks were actually illegal because it was considered insider trading or stock price manipulation. Why is this? Because one would have knowledge about when to buy shares. Recently, Senator Elizabeth Warren declared in 1982 when the SEC issued a rule to provide safe harbor from manipulation liability, buybacks were near zero. Last year, over $500 billion was spent on share repurchases. The buybacks were treated as stock manipulation for decades because that is exactly what they are. And the SEC needs to recognize this. According to Essentials of Strategic Management, the quest for competitive advantage, the balanced scorecard is a widely used method for combing the use of both strategic and financial objectives, tracking their achievement, and giving management a more complete and balanced view of how well an organization is performing. Hence, this seems as if the board of directors and top management, the wolves, have the keys to the proverbial chicken house when determining when a stock repurchase is necessary. Stock buybacks are typically financed with debt. In general, debt makes the company's balance sheet less flexible. According to Investors Alley, Dennis Miller, a recent Zero Hedge article includes a chart outlining corporate bond debt issued since 2000 and includes virtually every single dollar raised through the issuance of debt has been used for one thing: to buy back stock. So what is the issue with Macy's debt and stock buybacks? The underlying issue with Macy's stock buybacks is creating an enormous amount of debt that could stifle future growth. According to Adam Levine Weinberg of The Motley Fool, after spending huge sums of money on share repurchases in recent years, Macy's has indicated that it will focus on reducing its debt in 2017. Currently, corporate debt has recorded highs and has a direct relationship with the gross domestic product, GDP, the total dollar value of all goods and services produced for a specific time frame. Simply put, if a company's cash is being used to service debt, then there is less cash to upgrade facilities, hire employees, expand operations, research, and development. The many years of large stock buybacks have had a negative impact on Macy's financial stability and creditworthiness. According to Moody's Investor Service, Moody's downgraded Macy's Incorporated senior unsecured rating to Baa3. Its senior unsecured commercial paper rating was downgraded to P3. The outlook was changed to stable from negative. The following debt-related ratios provide a picture of Macy's current debt problems. Macy's net debt, earnings before income taxes, measures a company's debt compared to earnings creditors and investors prefer a ratio under 2. Macy's recent financial information indicates a net debt earnings before income tax ratio of 4.9. Macy's earnings before income taxes / interest expense ratio measures how much of earnings are used on interest payment. Currently, Macy's ratio is 3.8, but the preferred range is 6 or higher. According to Lawrence Myers of MSN.com, Standard & Poor's recently downgraded Macy's credit rating, which was cut from the BBB to BBB- last week, just one notch above the junk status, with a negative outlook. Additionally, the S&P is concerned about Macy's debt, even though Macy's states that they will focus on reducing debt in 2017, per Helena Song, S&P credit analyst. The downgrade reflects our view of the company's sustained weakened operating performance and our expectation that adjusted debt to earnings before interest, taxes, depreciation, and amortization will remain about 3 times in the next 12 months. Despite the company's plan for debt reduction, accordingly, we think there could be a need for further debt reduction in 2018 for leverage to drop below 3 times. The net debt to EBITDA ratio, insight of how long it would take Macy's to pay off their current debt. So a debt ratio of 3 times means it will take Macy's 3 years to pay off the current debt. But does not take into consideration interest, depreciation, tax, or amortization. Also, having a high debt ratio will often result in a lower credit rating for business. Is the debt associated to buyback stock issues unique to Macy's? The debt issue due to stock buybacks is not unique to Macy's. Justin Langhart of the Wall Street Journal stated U.S. companies borrowed heavily in recent years, but often bought back stock rather than investing in their business. Typically, buying back stock with debt is contentious to some when sacrificing future growth. Taking on additional debt instead of investing to company is a key dilemma for stock buybacks. The retail merchandising business that Macy's operates is experiencing huge competitive conditions. Too much debt can negatively affect their business and operations. What was Macy's response when debt-associated stock buybacks became public before and after? Macy's initial response to their increasing debt, which is directly related to stock buybacks, was the bond tender offer we announced today and the ongoing repurchase program. Taken together, will result in lower interest expense and reduced share count. Given the strong cash flow generation of our business, it is important to recognize that these actions do not limit Federated abilities to pursue strategic investments. A recent article by the Motley Fool stated that Macy's will be focusing on reducing their debt in 2017 and cutting back on stock repurchases. So in our opinion, top management has a fiduciary responsibility to reduce the debt associated with stock buybacks. If companies were buying their stock when its price was low and selling it when it was high, there might be a good case for share buybacks, but as the Financial Times points out, most do not do that. They buy high and sell low. Based on the responsibility, the following are our recommendations. Stock buybacks should be purchased with extra cash if it's the best use of said cash. This would eliminate debt due to stock repurchases. Stock buybacks should not be purchased at the expense of research and development. Dividends instead of buybacks should be used to distribute money to shareholders. If the goal is to return cash to investors, dividends are actual cash returns. According to the Essential Strategic Management, the quest for competitive advantage, sustainable business practices are those that meet the needs of the present without compromising the ability to meet the needs of the future. In our opinion, stock buybacks threaten the future opportunity and need for expansion, employment, and quality of life. Hence, we jeopardize long-term success for an immediate short-term success.